Hey traders, happy Fun Day Monday. This is Ron Haight. I hope your week is off to a great start. As always, everything in this presentation is for educational purposes only. We'll kick off here using Thinkorswim. This is a daily chart of the S&P 500 ETF, the spiders. Look, fresh, new, all-time highs. Happy days are here again and again and again. It's Cinco de Mayo, party like 1999, whatever you want to call it. Bulls have the edge in the daily chart. Is it getting ridiculously frothy? Sure, we can argue that a while ago. But the trend is your friend, and that's one of the most powerful statements, phrases I've ever heard. As being a trader, the trend is your friend until it isn't. So all I do is, if I was watching here, we're staying above the orange line. That's the big one. The red line has even been pretty gosh darn awesome since July 1st. The first sign of trouble, like I say whenever I do these videos, the red line is the 20-day EMA. We break below that, that's a yellow flag. And we broke below it here, but never broke the 50 in orange. Broke below it here, used the 50 as support. So that's the yellow flag warning, that red line. Now, the orange, the 50-day SMA, we break that, flat out bearish. Until that happens, bulls get the edge, and traders are being rewarded handsomely. The market just seems to tack on a few points, a few percent every week right now. We take a look at the Qs, they're even more happy. They've been setting all-time highs for a while. Even if they do get 1 or 2 down days, it does no technical damage. What are we close today? 286.63 it looks like we're at right now, ballpark. So Qs and SPY are leading the way. Diamonds, nice pop today. They're lagging, not at the all-time. Oops, before I go there, today's little breakout, I zoom in. Now the all-time highs are the target. We finally took out this swing high and this swing high. Now if we go to the Russell, they bounced off their red line. They are definitely lagging. They are not back up to their previous highs, the yearly highs, which is over here. But even they are bullish. So strongest, spiders, Qs, the weakest, diamonds, the Dow, and the Russell 2000, your small caps. Now I want to transition to some seasonality stocks. Here's into it. So over at my other company, financial.com, I've been hosting webinars, open houses. They're over right now. And I've been sending out the replays saying, hey, you got to watch these stocks. It literally can change your year. You start trading with more confidence because you're using the stock's own track record as your secret weapon. So it sort of sets aside the theory from fact, and we're trading with fact-based data when we use financial. So from a seasonality effect, now this company is due to have earnings. This is into it to make her quicken. Tomorrow after the bell, we were talking about it over here, and what happens? It runs right up into earnings, right on schedule. It's already up 20, 25 points. Almost 30 points since we started talking about it just a week and a half ago. When I get those runs into earnings, even though it typically has a seasonal bias to its earnings report, not a bad time to consider taking profits if I wanted to do so. So this one running up into earnings. Let's see what happens with earnings. But it played out perfectly so far. NVDA, a company that has earnings. I brought this to you guys back, and by the way, with Intuit, with NVIDIA, MasterCard, who we're going to look at next, all these I was talking about early to middle of August. Look where MasterCard goes from. What, 420s? Straight up, it's almost up 100 points. And this is NVIDIA, right through an earnings report. How could you know? This stock has a crazy track record too. It's sort of like, wouldn't you like to know which stocks were about to move before they did it? And that's the power of the seasonality. That's what we do at Financial. Now here's MasterCard. Here's another one. The early part of August. We're sitting over here. Here was earnings. It's lollygagging around at what, 310. Now it's at 340, 10% in a couple weeks in this month alone. You start looking at long call options with about 3 months in time, and you go right at the money. You have 10% moves. These options start approaching doubles, and it's in weeks later. So MasterCard's going up according to plan as well, and it's right now on target at the all-time high, which is what, a couple bucks away at this point. So seasonality continues to work. Well, it doesn't matter if we're bullish or bearish. If the market rolls over, we can look at seasonally bearish stocks too. All right, now let's move on to Apple. Speaking of seasonality, there's really only 2 periods of the whole year that Apple goes down. The biggest down move is coming up. So Apple traders, I'm putting you guys on notice. If you go back and look at the very end of August to September, you can do this homework on your own. You'll be blown away at how many times Apple goes down. So because that happens, not every year, but the majority of years. You cannot be surprised if Apple starts to roll over here. And let's face it, since they announced their stock split, pre-earnings it was around 380, post-earnings it was 4.25. It's 90 points higher in what? Not even 4 weeks. And you can see the split is due on 8/31. Now, when a stock splits, it's 4-for-1. If you had 100 shares, you got 400, and then it's 1/4 of the price. It's going to go from 515 divided by 4. You'll be in the $100 share range, 100 and change. Here's my point. When people have that many extra shares, A, it makes it more attractive to pick up more shares because it's cheaper. But also people get this idea that, and it's a little weird, oh my gosh, if you had, 1,000 shares of Apple, you have 4,000 shares of Apple. They sell. And it almost creates this, it does create a dip. You package that theory, well, not theory, it's what often happens with stock splits because of the extra shares in someone's account. As crazy as that sounds, people sell for that reason. You combine that situation with their developers conference / new product announcement in September, we might have a perfect storm for Apple to dip. So with all that said, if I was trading Apple knowing it's about to enter a seasonally bearish window, from a probability perspective, I'd keep this thing on a short leash. And maybe what I would consider doing is instead of using a 20-day EMA as a trailing stop, I'd bring in an 8-day. And the moment it closes below the 8-day, I might consider trying to take some short-term profits if I was playing Apple short-term bullish. Or maybe I start thinking about, do I want to start hedging a little bit knowing that this company often has a dip? If you're new to the market, this is almost like shooting fish in a barrel. My quote is, one of my favorite quotes is, even a blind squirrel can find a nut once in a while, meaning you're good by accident. The market usually doesn't do this, and it just pounds out gains every single day. And it's happened to Apple and so many others. So what I'm saying to you is keep an eye on this one. Maybe it keeps going. History says it runs into some trouble right around that conference. All right, that's Apple. How about Tesla? Question on this one because of a stock split. They're due for a 5-for-1 on the same day, according to thinkorswim. Now, today you had bearish engulfing, but Tesla's done that before. We had bearish engulfing even after earnings, and then it starts ripping. So fractional shares, we've talked about this before, that's probably helping Apple, Tesla's, Facebook's, Google's, Microsoft's, Amazon's. That if you have a small amount of money, you can't really afford to trade. But with fractional shares, you can. And then you get a piece of the pie, the Apple pie or the Tesla pie. For Tesla, same thing. Maybe bring in an 8-day, watch for these stock splits. The stock divide 2,100 by 5, and all of a sudden you say, wow, it's a lot more affordable. But because those extra shares are put in the accounts, you'll be blown away. Some traders will simply sell, not for any fundamental reason, just because there's more shares in their account. It's like, that's an interesting reason to sell, but okay. We might see it catch some selling pressure here too. But again, what if it doesn't happen? That's why I think an 8-day EMA could work as a nice trailing stop. And you know what? If you want to see what that looks like, we can go studies. We can add a study. We can come over here to moving averages, and then we'll come down to moving average exponential. It's going to put another line in. Let's click on it. We're going to put that puppy to 8, and let's make it blue. I'll make it like a teal color and hit apply and OK. Now that blue line is going to be the 8-day. So the stock's at 2014, the bluish line, teal would be 1877. Below there, that might result in a stop out. This is a momentum-based trade. When stocks really run, the 8-day can work really well. When you get below it, you're stopped out. That short-term momentum is over, and then you can see Tesla went choppy. Now, if you want to see what the 8-day looks like on Apple, since we put it on there, why not look? Look how it's just sort of catching, caressing the stock, and it's pushing it higher. The moment we get below there, short-term bullish momentum is over. And then we get below the red, that's the yellow flag, orange, red flag, full-blown sell signal in the daily chart. I'll leave the 8-day in there for now. Let's go look at Amazon. All right, Amazon broke out back on the 18th. It's now just biding its time. It's doing another mini bull flag. It's just a consolidation. This is still very bullish. I would watch the red line since it's worked pretty well here. Amazon isn't as momentum-ish as Apple and Tesla right now. Sure, this thing's up huge, but it's gone through consolidative phases. So here I would stick with the 20-day, again, from a paper trading perspective, educational perspective. How about Walmart? They were in the news because they're going to have the Amazon killer, so to speak. They just had earnings. Their sales are just bonkers, but they're like, looking out, people probably aren't going to have this money, which is incredible. With the stock market being so high, yes, there's going to be a price to pay for giving out all this free money and when that free money ends. So right now, Walmart's sort of caught. It is below if we look here, it's below, well, it's below the 8 in blue, but it's right on the 20-day. If I was watching Walmart here, I would just be cautious. You have the surge on the prime killer, then the consolidation, you've had earnings, they didn't say the best things, and it's trending lower. But we didn't take out the previous lows, and we haven't taken out the 50-day. Therefore, if I was trading Walmart, the 50-day to me is huge. That's only about $4 lower right now. Now, it could go from here to here, or lower, of course, in a heartbeat. But assuming it starts trending lower, breaks the 50, that's where I might go into some protective mode on my Walmart shares, if I had some. Now, Ford. Question on Ford. Today it was up. The 50-day in orange remains the stop. It hit it there, got below it, but closed back above. We're also seeing green bars starting to exceed red bars. Very interesting. So the selling pressure, even though there's more selling days, the volume is actually drying up a little bit here. So this is interesting. Below the orange, the bulls would lose the edge, but Ford does look possibly interesting. Now here's Peloton. The stock pre-COVID was in the 30s and the 20s, got down to 17. Now it's reversed those digits. It's 73. If we zoom in, it's really been following the red pretty good for quite some time. Got a little below it here, a little below it here. So it's not perfect right now. And today was bearish engulfing. And we had bearish engulfing over here too. So how would I trade Peloton? First off, I would not want to buy it up here because at some point everyone's going to have an exercise pike in their home. I would watch the orange. The fact that this stock is now consolidating, and with today's move, there's a possibility of a head and shoulders forming. Head up here, left shoulder here with the bearish engulfing, and then right shoulder here, interestingly, bearish engulfing. Volume did pick up a bit today. The selling volume is not extraordinarily high. In fact, the green bars are looking quite positive right now. But the fact that we're not jumping to new highs might be it's getting tired. And once the selling finally comes in at some stage, whether it's now or next year, we want to watch the orange. So right now, would I be concerned if I had Peloton? I'd be watching closely. I'm not overly concerned yet, but I'm waiting for these things to crack. And the orange line would be the sign. And then here's Shopify, another one that's just had an amazing run. Was what, in 300s? Now we're at 11, just insanity. Same thing, look, going sideways. We are not setting new highs anymore. In fact, this it really didn't take out that low, but it was pretty darn close. This could be a head and shoulders forming as well. Orange line, that's where the alerts need to be. We close below it, bears get the edge. So there you have it. I don't know if we'll do a video midweek if things just keep rolling higher. There's not a lot to talk about. Blind squirrels are finding nuts right now. But if we end up getting a big down day at some point and we start breaking moving averages, I'll jump on with a new video. Otherwise, I'll see you Sunday. Yesterday I had crazy days, so much going on. I didn't have time to do the video. There was really nothing different to talk about from then to today. So here's your video today. I hope you find it helpful. Keep an eye on some of those moving averages for some red flags. So with that, I wish you guys a fantastic rest of the week, and I look forward to seeing you in the next video. All the best.